Thinking of buying PayPal stock on the latest surge? You're not alone. After months of heavy losses, PayPal stock is making a comeback, and investors who think the stock has been undervalued are enjoying the recovery. But is PayPal's recent surge a sign to buy before it booms, or are we seeing the start of a value trap? In other words, is PayPal's success here to stay, or are investors setting themselves up for disappointment? PayPal's share price is booming after its latest quarterly earnings report, which shows numbers up across the board and high expectations for the coming months. Add in the recent release of Fastlane, PayPal's new accelerated checkout experience, and PayPal certainly looks more attractive than it did a few months ago. Not to mention, we have newly minted CEO Alex Chriss, who spent his first year in the big chair, reinvigorating PayPal's history of accelerated growth, acquisitions, and product releases. This combined good news has jolted PayPal's share price over 8% in the last month. But one solid earnings report and a new product aren't enough to buy themselves to make PayPal a buy. There has to be more to the story, and our market experts dove deep into PayPal to find it. In this video, we'll take a look at PayPal's value against the current market and the financial risks it's hiding behind the curtains, PayPal's position against Visa, a legacy competitor that could teach this scrappy stock a few things, and the strategic challenges PayPal faces in the coming months. All this to answer the question, is PayPal a value stock or a value trap? Let's find out. Let's start by examining how PayPal's value compares to the broader market. Right now, PayPal's stock looks incredibly cheap compared to the S&P 500 index, which we're using here to stand in for the large, successful stocks in PayPal's peer group. For one, its price to earnings sits well below the market's, meaning PayPal investors pay less per dollar of PayPal's earnings than for the average stock in the index. However, PE alone doesn't make a stock a value buy, just a cheaper one. PayPal's also lagging in its price to book and price to sales ratios, underperforming not just against its peers, but the entire S&P 500 index as well. What does that mean right now? After getting swept up in the pandemic-era boom and bust cycle that included names like Zoom, Peloton, and even UPS, PayPal finally looks like a solid value stock again, at least compared to the market, suggesting it has plenty of room for future growth. So if the company can overcome its current challenges, could its share price have a resurgence? But as always, there are no guarantees in investing, and PayPal has always been a bit of an Icarus, flying close to the sun and taking lots of risks. Which brings us to those pesky risks PayPal is hiding behind the curtains, namely PayPal's debt concerns. In recent years, PayPal has expanded its product line into the unsecured buy now, pay later market, with financing options like PayPal Credit, Pay Monthly, and Buy in 4. On one hand, becoming a one-stop financial shop might give PayPal the user growth boost it needs, but stepping into the unsecured consumer debt space is risky, especially since some of those financing options don't charge interest, limiting PayPal's ability to profit off those risks. And what does it cost PayPal to carry these risks? Data from PayPal's earnings reports shows the company paying a seemingly continuously growing portion of their revenue just to generate sales. 10 years ago, PayPal's annual cost of sales was a respectable 35%. Today, that number tops 54%, far above Affirm, a key rival that has managed to scale operations much more effectively, and in fact, has managed to rapidly reduce its annual cost of sales. PayPal is also carrying substantial liabilities compared to its equity. In its most recent quarter, PayPal reported $61 billion in total liabilities, compared to just $21 billion in total equity, a 3-to-1 ratio. Meanwhile, Visa, a far more traditional payment provider, boasts a ratio of just 1.3 to 1. These liabilities look even riskier as the consumer debt space grows more uncertain. Early 2024 data shows that credit card delinquencies this year have risen much higher than 2022's numbers. At the same time, inflation, high interest rates, and slowing worker wage growth continue to pound the average person's wallet. As the cost of living continues to outpace incomes, it's likely that consumers will rely on debt more heavily in the future. And the more of that debt PayPal owns, the more risk it's taking. Lastly, PayPal's push into consumer financing has effectively pushed it to become a shadow bank, offering credit without wading full-on into traditional banking. Up front, this sounds good. PayPal gets to profit without jumping a bunch of expensive hurdles. However, shadow banks don't have the same protections and safety nets as traditional banks. So, what does that mean for PayPal? PayPal has exposed itself to massive regulatory risk. Shadow banking is big business, and big business attracts regulators. The Federal Reserve is already looking into the risks of shadow banking, and investors can expect more scrutiny in the future. PayPal is on shaky financial ground. Right now, it has billions in risky, short-term loans sitting on its bottom line. If consumers' ability to repay their loans continues to shrink, PayPal and its investors will suffer. PayPal is moving into a space that Apple itself vacated. Regulatory and credit risks are just two reasons that Apple left the buy now, pay later market almost before it got started. Despite one of the biggest powerhouses in the world outsourcing its financing risks to third parties, PayPal's determined to take those risks. In short, despite its attractive value compared to the competition, PayPal's taking a lot of extra risk that many of its peers have avoided altogether. These gambles could pay off in the long term, or sink the business. Okay, so PayPal definitely looks like a value stock, if a bit risky, though that's often what makes value stocks a great buy. Now, let's take a look at how PayPal compares to Visa. Broadly speaking, PayPal and Visa operate in similar spaces. They both settle payments. They play important roles in the credit markets, and they have similarly sized balance sheets and rake in about the same revenues. In their most recent quarters, Visa outperformed PayPal by just $1 billion, and last year by just under $3 billion. That's also pretty close performance for a legacy card giant and a modern century fintech disruptor. It's also where many of the financial similarities end. We'll get to that in a moment. First, let's look quickly at how complex the payment system space has gotten, and where PayPal and Visa both fit. You probably know Visa as the go-to card network that built modern payment systems, the middleman between merchants, card issuers, payment gateways, and payment processors. Essentially, when you swipe your Visa-branded card at checkout, Visa makes sure your money gets from A to Z. The company profits by charging a fee on every transaction, which is why Visa's often equated to a toll booth on the highway. It built the infrastructure, and now it charges a toll to use it. PayPal, on the other hand, sets more restrictions than Visa, making it more like a gated community. To participate, everyone involved in a PayPal transaction has to have an account. No exceptions. You might think that gives PayPal more leverage to increase its user numbers, but it often limits its potential. When one person or merchant doesn't have a PayPal account, are they going to set one up? Maybe. Or they might use Zelle or Apple Pay, or their Visa cards. Plus, PayPal doesn't always charge a fee for accessing its gated community, which limits its profits. However, PayPal is also more flexible than Visa in some important ways. For instance, it owns Venmo, giving users another in-network payment option, and it also offers lending products, PayPal-branded debit and credit cards, and even technologies like cryptos and stock trading. In the past, this flexibility got PayPal in hot water with Visa and MasterCard because it siphoned off their profits. After some tense discussions, PayPal signed a deal with both companies to stop actively discouraging users from using their cards in exchange for compensation. PayPal also gained access to Visa's technology, so people could use PayPal in physical stores, which greatly expanded its use potential. Okay, that's all fine and good for now. PayPal's turned two of its biggest legacy competitors into partners, but PayPal still has a problem. Despite partnering up and offering many of the same services, Visa is much more profitable, and PayPal doesn't have a lot of room left to expand in its own market. You see, PayPal already owns 45% of the market share in the payment gateway industry, which gets more crowded every year. At the same time, its numbers look a lot weaker than Visa's. This is where those financial similarities I mentioned earlier end. To start, despite bringing in nearly the same revenues, Visa's payment volume dominates PayPal's by nearly 10 times. Visa also dominates in net income and operating income, especially when you zoom out to look at their annual numbers. These are some pretty major differences, and they bleed into the numbers that investors care about. Across the board, Visa performs better in its price to earnings, price to book, and price to sales data. We also see PayPal struggling to maintain a healthy margin in recent years. Visa's margins haven't grown much lately. Actually, not at all between 2020 and 2023. But when you're pulling a 65% operating margin, you don't need to grow to say you're doing well. But PayPal? Well, PayPal's grown from just 15% to 17% since 2020. PayPal doesn't even meet the S&P 500's operating margin, let alone the finance industry's average. Though again, that's room to grow if the company plays its cards right. Where's that leave investors? Well, when you look at PayPal compared to Visa, PayPal definitely looks like a clear value stock. The scrappy underdog compared to the world champ, just waiting to take shareholders to the next level. But these metrics also say something very important about Visa, and in turn, where PayPal needs to go if it wants to remain viable. Even though it's a giant with little room to move, Visa's history and solid performance make it a cornerstone for investors who like a sure thing and regular dividend payouts. If PayPal hopes to grow more profitable and attract loyal investors, leadership needs to step carefully and look to the long term. You can actually see this reality reflected in PayPal and Visa's stock performance. Visa's far more stable than PayPal on basically every scale, with a long history of upward performance and only occasional drag. Even in the past 5 years, Visa's price hasn't dipped below $150. That's pretty impressive. Compare that to PayPal's stock performance, and things don't look quite so rosy. Sure, PayPal's up long term, but it's not exciting the growth and value-focused investors who made the stock what it is today. Alright, we've seen how PayPal stacks against the market, how it stacks against the competition, and a little bit about where PayPal hopes to go if it wants to keep investors excited. Now, let's step back for a moment and explore just how PayPal got where it is today, so we can see what kind of strategic challenges it's facing for the future. PayPal started in the late 90s. Like most great inventions, PayPal began with a good idea, but it needed a big break to become great. So in 2002, PayPal boldly went public, the first consumer internet company to do so in 18 months. Its Nasdaq debut saw its price surge 55%. Shortly after, PayPal integrated with eBay, where it became a household name and early fintech success story. As it grew, it combined technological ideation like HTML payment buttons and next-level security with a dash of recklessness. 13 years later, the two businesses disentangled, and as PayPal's market value shot past eBay's, it was clear its gambits had paid off. Let's take a look at that calculated dash of recklessness that I mentioned. Over 2 decades, PayPal poured much of its profits into strategic acquisitions, spending billions to level up its security and fraud management infrastructure, deferred payments options, and mobile capabilities. In 2013, PayPal shelled out $800 million to break into the social transaction market with Braintree and Venmo, and 2 years later, spent over $1 billion to capitalize on digital money transfers with Zoom. That's a lot of money for a company that's often failed to meet growth targets. Still, at every step, that big spending paid off, keeping PayPal ahead in an increasingly competitive field. Importantly, present-day PayPal wouldn't be where it is without that strategy of rapid-fire acquisition and integration. In the process, it designed a PayPal-driven ecosystem, kept afloat by a self-sustaining network of merchants, consumers, and even legacy payment giants. But now, new threats are moving in, threatening to destabilize that ecosystem. Leadership transitions, intense competition, evolving market dynamics. It's a whole new landscape for PayPal. Visa faced its own set of challenges back in the day, but unlike PayPal, it didn't have to compete with Zelle, Apple Wallet, or cryptocurrency, and it wasn't taking on the same types of credit risks that PayPal has. Yet, to succeed, PayPal needs to do what Visa did: acquire new accounts and get existing accounts to make more transactions. Unfortunately, making those strategies profitable is usually where PayPal falls flat. That's where concerns about PayPal's debt financing strategy comes in. Yes, it gives users a new reason to use PayPal, but it's a risky move as the American economy continues to teeter near recession. why does this all matter? Because PayPal started with a great idea. To make the idea work, it had to copy Visa, building the modern payment infrastructure from the ground up, acquiring new pieces, and taking risks. These strategies made PayPal what it is today. But if it wants to grow, it's got to balance risk and reward in a way that legacy competitors don't have to. Visa's already changed its game. Now, PayPal's got to make its own game more profitable. How? I've already touched on PayPal needing to get more growth to impress investors. But really, PayPal already owns 45% of its market share, which is part of the problem. Unless it expands outward, it doesn't have anywhere to go. That realization for investors has seen the stock decline massively since July 2021, and now it's trading at lower multiples, taking on higher credit risk, and barreling into a higher default environment. As our experts see it, PayPal has multiple strategic decisions to make in the next couple of years. Is it going to expand through acquisitions and new innovations? Is it going to move out of its growth phase into a more mature company with stable revenues? Is it going to start paying dividends and really capitalize on buying shares back from investors? I think PayPal's history gives us some clues. Already, PayPal started moving from aggressive acquisition to internal innovation and maintaining its market. It's nearly doubled its share buybacks since 2021. However, it hasn't initiated a dividend payout that could capitalize on this momentum by attracting investors to boost its value. And despite being a market leader, PayPal still has room to grow its value, if it wants. It's got a revenue growth rate of 9% and an estimated $6 billion in free cash flow, so dividends shouldn't be a problem. But PayPal also has a new CEO, just approaching his first full year in the position. Alex Chriss has been very public about acknowledging PayPal's challenges, and optimistic about where the company can go. However, he has to balance reinvestment, investor happiness, and strategic acquisition and innovation potential that could prevent PayPal from realizing its value potential in the near term. PayPal's always been incredibly adaptable, but now it's at a crucial point where competition is intensifying, growth is slowing, it's underperforming compared to the market and its own partners, and it's taking on new financial risks. Still, as we saw with the second quarter earnings announcement, PayPal does have the ability to sustain its top-line growth. It can deliver those numbers that investors want to see pop its stock price. What's all that mean for investors though? After weighing all the evidence, our team of market experts look at PayPal as a buy on deep value stock. In other words, it's heavily undervalued compared to the market. It's facing several substantial risks and challenges, but if it can keep innovating and acquiring and partnering up and really make those gambles pay off, investors could see some major profits. This is what we call a distressed investment. It has tons of potential to go sideways or even down, but investors who are willing to take that risk could also ride the upside. And right now, our money's on PayPal as a deep value buy, not a value trap. If you want to watch PayPal's journey, you can find a direct link to our website. And if you want daily financial news, opinions, and hot market takes, follow us on Instagram. Don't forget to like and subscribe, and we'll see you next time.